No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I am Hank Parrott, your host. We're going to be talking about a little bit about the market. I'm going to start with, and then we're going to get into a lot about taxes because our tax deadline is approaching, right? We've got that. We had the extension that was automatically given to take us to July 15th. And now that's not that far away, a few weeks away, and we've got our tax filing deadline, at which time we have to make some choices, right? Either file your taxes, or if you're going to file an extension to take it out to October 15th. Keeping in mind, of course, that if you file that extension, you still have to, if you owe any taxes, you still have to pay those by that deadline. And we're going to get into more with that, and we're going to have Dr. Friday joining us about that. But first, I'm going to talk a little bit about the markets. In particular, there's been a lot of volatility this year, as you know. We've seen, in fact, and it's maybe, it has, in fact, created some anxiety out there. And so I want to alleviate a little bit of those concerns. As I've been talking about over this whole year, actually, and before, is keeping perspective about the markets. We're long-term investors. This is part of our retirement planning, is that we are invested in the market, likely invested in the market, not everyone, and there's some exceptions, and I'll go into why. But when you're invested in the market, understanding that there are going to be down periods. We're going to have bear markets. We're going to have periods where the market can be down. If we look at the last two bear markets prior to this one, in 2000 through 2002, the market was down over about 46%. From October of 07 to March of 09, the market dropped 55%. And then most recently, from February 19 of this year to March 23rd, when it bottomed out, the market dropped about 34%. Now, of course, that was more of a self-imposed bear through the closing down of the economy that created that and created the recession that went with it. So just as it was self-imposed, now that we're starting to reopen, we're seeing the market is going back up. We're down right now, I think, about 3 to 4%, right in between 3 and 4% year to date. If we look over the past year, from a year ago to today, we're actually up about 10%. So that's how strong 2019 was. There's going to be some changes then that come into play as we look at the rest of this year. So one of the things there is we're actually ahead. I didn't expect us to hit these levels probably until the fall. So it's good to see that we're rebounding even faster. But that's not to say we're out of the woods with regard to volatility, or for that matter that we may not see some additional downs, or the election. It's an election year that can create a lot of volatility in the market, depending on what happens there. Statistically,
Retirement report.
When the market goes down, we see that statistically in years, when there's an election year, the market goes down if the incumbent loses. And then after about 6 months, it recovers to where it was. And you see the same thing, the markets typically, if the incumbent wins, go up, and then that can smooth out as well. So we're not sure how that's gonna play out. There are a lot of factors there that we have to be aware of. The biggest one is understanding, as long as you have a good plan in place, as long as you're utilizing modern portfolio theory, and meaning you're really paying attention to your asset allocation modeling, that's going to be the biggest determinant of your returns and the volatility you're going to experience. So simply put, if you've a 50-50 portfolio of stocks to bonds, when done correctly, okay, very key, when done correctly, will reduce your risk dramatically, cut it in half in many instances. So now if we reduce our market risk in half and recover much faster, this makes it a lot easier to ride it out. Now, the other key component here is having an income plan. If you're in retirement or near retirement and you're going to be going in not knowing, am I going to be in a bear market, a bull market, or a flat market, how do I plan for that? And you need to have a contingency for each one of those. So with my clients, for instance, one of the things we do is we make sure that the income piece is covered. So we have 3 to 5 years worth of income that is invested differently those income needs differently than our longer term investment strategy. And there are different ways I've shared with you many times on the show, laddering strategies, ways to basically have monies set aside for that 3 to 5 years, for the 6 to 10 years, and for the 10 plus years. So we're going to talk about that this year. This is one of the things you want to pay attention to. With all this volatility, this is a great time to revisit that asset allocation. Make sure that you have an income plan in place, whether you're laddering out your portfolio, meaning a more conservative piece for the income needs that are right now, and then getting more aggressive as you go through the ladders, the years, in other words. So for 1 to 5 years, I'm going to have a very conservative strategy. For 6 to 10 years, I'm going to have a more moderate strategy. And then for 10 plus years, more of a growth strategy. And there are other ways. We've talked about fixed index annuities, a number of ways that you can also plan in for income and smoothing out that volatility. So it's a good time to do it. So in all this anxiety that's going on, and we've got the virus, and we're seeing spiking. There was a great piece by Governor Ron DeSantis down in Florida. I'm going to be going down there next week myself. And it was very encouraging to see that even though cases are going up, hospitalizations have been going down. So that's a big plus, and it has to do with the planning that's going on, the additional testing that's going on, but also they're being very careful and are really watching what's behind these spikes, not just having a knee-jerk reaction, a very, very intelligent approach. So I was very impressed with that. And I've seen, for instance, the average age down there from age 65 for contracting the virus down to age 37, and one of the lowest age groups as far as risk goes. So you're seeing a lot more moderate or mild type of cases. So they're not requiring hospitalization, they're not requiring, in some instances, hardly any care. So these are some things to keep in mind for this year. Most of this is positive news. We're seeing therapeutics that are picking up. A lot of good news on the horizon for that. So what we want to pay attention to then, again, asset allocation, pay attention, stay invested, stay disciplined, don't worry. Yes, there's going to be more volatility, there always is, but at least this appears to be one of the shortest bear markets ever, and that's a big plus. The same with the recession. What we're going to be talking about today then, might recognize this, our Form 1040. All right, so there's been a lot of tax legislation that has passed, one of them being the extensions that we talked about with regard to tax filing. So today we're going to get into talking about taxes, preparing for your the tax deadline that's coming up, talking a little bit about two recent tax legislation passes. One, the Secure Act, which was passed at the very end of last year but does affect this year's taxes, and the CARES Act, which of course gave us the extension. And we'll also maybe talk a little bit about just a couple of years ago, the Tax Cuts and Jobs Act. I'll get it right. Which was passed back at the end of 2017. It was one of the first major legislations in President Trump's administration. And in this one, that does affect your taxes. That's maybe, we've been talking about that over the last couple of years because it's affected 2018, and last year, of course, 2019. So we'll revisit some of that as well. And to help me with that, I've got Dr. Friday with Dr. Friday's tax and financial firm that's going to be joining us. Look at this. I've not done Zoom. This is my first time with Zoom on the show. I mean, we've done it like at church.
There you go.
We do things there where we get we do a Bible study, and even which is fun. You get everybody there. Even done some exercise classes with Zoom, which is a little unusual. Yeah, but this is the first time on the show, so welcome. How you doing this morning?
I'm doing awesome.
There we go. Got the bunny slippers on, I'm sure, right?
Flip-flops, but close enough.
There you go. Relaxing. Okay, we're going to be talking about taxes. So you got to, July 15th is coming up very soon. I imagine things are picking up as far as getting taxes ready.
Absolutely. And just keep in mind, even though we have this extension, just as Hank kind of did the opening, the July 15th is our for this year only are April 15th, which means that you have to have paid, in this case, you need to pay two estimated, if you qualify for paying estimates, your usual April 15th, your June 15th, both of those got extended till July 15th, as well as if you're going to file an extension, it will still only go to the October, so they're not giving us the full 6 months that you would normally have with an extension, as well as you need to pay the money or at least make an estimate so that you're not hit with additional penalties or fines for not paying the money. It only extends the paperwork. And more importantly, ideally, try to get in and get your taxes done, even if you decide you want to extend them, so you do know how much money you owe, or if you have a refund coming. I have people coming in every day that are still filing. I mean, obviously you need to file, but they have refunds coming, and so it's very important that you get your taxes done on time, because the fines can be pretty expensive if you don't.
There you go. Well, this is now they've extended. So the estimated taxes that you're referring to, of course, are for 2020, right?
Correct. Your first two, yes.
So even though we've been given the extension for filing our 2019 taxes, has this allowed then that they've, even though if you're going to have an estimate, for many people they don't know what that estimate is going to be until they file that 2019 return. How does that play into the file for estimated? Is the IRS going to be somewhat forgiving if they don't make that first one, or do they need to make two payments now?
Right. Well, I mean, obviously the point would be you have to have your taxes filed by 7/15. At that time, you would know what your estimates were or are for the first two estimates up for all forks. They're based on your 2019 taxes. And it's going to be interesting. 2019, people were working, had businesses that were achieving profits. And in 2020, some or many haven't been working, so they're not as worried about making their estimates because they're not going to have the income that they expected in 2020.
Right.
So there's some adjustments being made, but the tax law basically says 4 equal payments based on the prior year. So if you misestimate, you could be in trouble.
Okay, we're going to take a break. Well, one quick question about that when we come back, though. I'm thinking about, well, could I do 3 payments? In other words, divide it into, instead of 4 equal, 3 equal. I know I overthink probably. But we're going to take a break, and we're going to get into some more. And there's other tax legislation we'll be talking about, the Secure Act, the CARES Act, and as I mentioned, the Tax Cuts and Jobs Act. So all of those and the effect on your taxes. Time to get ready to file those taxes. All right, first a break. We'll be right back on the Retirement Report.
Storm 5 weather update. For weather on the go, download the Storm Shield app.
But it would just be a couple showers.